You've been turned down before, maybe more than once. So when a sign on the lot says, bad credit, no credit, guaranteed approval, it doesn't read like a marketing slogan. It reads like relief. Finally, somebody who'll say yes. And here's the thing, they will say yes. That part isn't a lie. What nobody tells you is that yes was never the hard part. The dealer wants you to sign just as much as you want to drive off the lot. And the reasons why are where this whole thing stops looking like a favor and starts looking like a system. Let's start with a question that sounds obvious but isn't. Why would anyone lend money to someone banks have already rejected? Risk is supposed to scare lenders away. So either these lots are taking a huge gamble out of generosity, or the loan was never actually risky for them in the first place. It's the second one. And once you see how, the entire guaranteed approval pitch flips from an act of trust into a calculated bet that barely involves trusting you at all. Most car lots sell you a car, then a bank somewhere else decides whether to finance it. Guaranteed approval lots skip that step. The dealer is the lender. This model has a name, buy here, pay here, and the name tells you exactly how it works. You buy here and you pay here every week or 2 weeks, often in person, often in cash, directly back to the same building you bought the car from. That single structural choice changes everything downstream. A bank financing your car wants you to succeed. A defaulted loan is a loss they have to eat. A buy here, pay here lot doesn't need you to succeed nearly as badly because of what happens if you don't. You'll be asked for a down payment, often a few $100s, sometimes financed as a fee tucked into the loan itself. It feels like the first step toward ownership. It's actually the lot covering its own risk before the story even starts. Here's the arithmetic nobody says out loud. The car you're buying was very likely purchased by the dealer at auction for a fraction of the sticker price. Often a car with 120,000 plus miles, bought for a few $1,000s. Marked up, financed at a steep interest rate, and sold to you for 2, sometimes 3 times what the lot paid for it. Add an interest rate that can run anywhere from the high teens into the high 20s or beyond, and by the time the math is done, your down payment alone may have already covered a meaningful slice of what the dealer spent to acquire the car in the first place. Which means the lot's real risk isn't, will I get my money back? It's already halfway answered before you've made a single payment. This is the part that reframes everything, so slow down here. In an ordinary loan, repossession is a disaster for the lender. Lost principal, legal costs, a car that's now worth less and has to be resold at a loss. In the buy here, pay here model, repossession can be closer to a reset button than a catastrophe. Think about what the lot has already collected by the time a repo happens. The down payment, several months, sometimes most of a year of payments, often at an interest rate high enough that early payments are mostly interest rather than principal. Then the car comes back. It still has resale value. It gets put right back on the lot and financed to the next buyer under the same terms, generating a second down payment and a second cycle of payments from a car that's already been substantially paid for once. Run that twice, and the lot may have made more from one vehicle being repossessed and resold than it ever would have from someone quietly paying it off and driving away for good. This is why some buy here, pay here lots see a share of their vehicles come back to them, not as an unwanted outcome to be minimized, but as a revenue event the business model can absorb, and in some cases depends on. Once you see the repo cycle clearly, guaranteed approval stops sounding generous. Approval isn't guaranteed because the lot trusts you. It's guaranteed because the structure barely needs you to succeed for the loan to make sense. Your credit score was never the risk they were pricing. The car's resale value and the size of your down payment were. This also explains a tactic that catches people off guard days after they've already driven off: the callback. You're told the financing fell through and you need to come back in. either to sign a new contract at a higher rate, put down more money, or return the car. It has a name in the industry: yo-yo financing, sometimes called a spot delivery scam. The first deal was never necessarily final. It was a way to get you emotionally and logistically committed. Moved your old car, canceled other test drives, told your insurance you had a new vehicle before the real terms showed up. Regulators have taken notice of this pattern specifically. State attorneys general and consumer protection agencies have brought cases against dealers over yo-yo tactics and undisclosed add-on fees for exactly this reason. The second contract usually isn't a mistake. It's a second sale, disguised as a correction. There's a piece of hardware that quietly reveals how this whole system actually thinks about risk: the GPS starter interrupt device. It's a small unit wired into the ignition, common on buy here, pay here finance vehicles, that does two things. It tracks the car's location in real time, and it can remotely disable the starter if a payment is late. Think about what that device is actually built for. It's not there to help you. It's there so that if the loan goes bad, the lot doesn't need a repo truck driving around hoping to spot the car. They can find it in seconds and shut it off in the driveway. The device isn't a security feature bolted onto a normal loan. It's infrastructure built for a business that has already planned, mathematically, for a meaningful share of its cars to come back. Before you leave, there's usually more than just the car and the interest rate. Gap insurance, extended warranties, service contracts, sometimes even the tires get a paid protection plan. Individually, each sounds reasonable. Stacked together and financed into the loan, they're sometimes called packing, inflating the total loan amount with products that carry high margins for the dealer and stretch out how long and how much you're paying before you ever touch the value of the car itself. Here's why this matters more than it looks like it should. Every add-on financed into the loan increases the total owed, which increases the odds the loan outlives the car's usefulness. You can end up owing more than the car is worth long before it's paid off. That gap has a name too: being upside down. And being upside down isn't a side effect of bad luck. On a loan structured this way, it's closer to the default starting condition. Not because people don't notice the interest rate, because the alternative, in the moment, feels like no car at all. No way to get to work, no way to get kids to school, no other lender willing to say yes. The guaranteed approval lot isn't selling a car. It's selling the only yes in the room, and pricing that scarcity accordingly. This is the same psychological trap that runs through most bad credit lending, just with a windshield attached to it. When the alternative is framed as nothing, almost any terms look better than nothing. The lot isn't hiding this dynamic. It's built the entire sign out front around it. Step back, and the shape of this business looks a lot like other industries, built around people who can't easily walk away. The fine print isn't a flaw in an otherwise fair deal. It's the load-bearing wall. The car is almost a prop. What's actually being sold is access, priced at a level that assumes a real chance you won't make it all the way through, and structured so that even if you don't, the deal still worked. So the next time that sign says guaranteed approval, the honest translation isn't "we believe in you." It's closer to "we've already done the math on what happens if you can't pay, and we're fine either way." If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.